Exploring secured and unsecured lending. Understanding key differences in lending types. Presentation agenda. Secured lending overview. Secured lending involves collateral to secure the loan, reducing risk for lenders. It typically offers low interest rates. Unsecured lending overview. Unsecured lending does not require collateral, increasing risk for lenders. Borrowers may face higher interest rates. Comparison of lending types. Understanding the differences helps borrowers choose the best option. Secured loans offer lower risk and cost. Real-life applications. Secured and unsecured loans have distinct advantages and disadvantages in real-life scenarios, from buying homes to financing education. Understanding secured lending. Definition of secured lending. Secured lending is borrowing money against collateral. This can be property or valuable assets. Benefits of secured lending. This type offers lower interest rates and is less risky for lenders. Collateral types. Common collateral includes homes, cars, and other significant assets. Lenders can claim these if defaults occur. Characteristics of secured lending. Requirement for collateral. Borrowers must provide collateral exceeding the loan value for secured lending agreements. Assessment of collateral. Lenders evaluate the collateral's worth before approving secured loans to ensure safety. Security for lenders. If repayment fails, lenders can seize collateral, providing a safeguard for their financial interests. Examples of secured loans. Definition of secured loans. Secured loans are financial agreements backed by collateral like property or vehicles. Common examples. Mortgages and auto loans are prime examples of secured loans. Role of collateral. Collateral serves as security for the lender in case of payment defaults. Consequences of default. Missed payments can lead to foreclosure or repossession of the asset. Exploring unsecured lending. Definition of unsecured lending. Unsecured lending refers to loans that do not require any collateral from the borrower. Instead, lenders evaluate the borrower's creditworthiness. Reliance on creditworthiness. Lenders depend on the borrower's promise to repay, making credit scores vital. A high credit score increases the chances of loan approval. Higher interest rates. Due to lack of collateral, unsecured loans typically come with higher interest rates. This compensates lenders for the increased risk. Characteristics of unsecured lending. Dependence on credit score. Unsecured loans rely heavily on the borrower's credit score. A higher score often means better loan terms. Increased lender risk. Lenders take on more risk without collateral. This can lead to higher interest rates. Stricter eligibility criteria. Borrowers face stricter criteria to qualify for unsecured loans compared to secured loans. Higher interest rates. Due to the increased risk, unsecured loans typically have higher interest rates. Examples of unsecured loans. Types of unsecured loans. Personal loans, credit cards, and student loans are common examples of unsecured loans. Loan purposes. These loans are often used for debt consolidation or funding education expenses. Cost implications. Unsecured loans typically have higher costs due to the lack of collateral. Key differences between secured and unsecured lending. Collateral requirements. Secured loans require collateral, while unsecured loans do not. This is the fundamental distinction. Impact on interest rates. Secured loans typically have lower interest rates due to reduced risk for lenders. Unsecured loans carry higher rates. Approval criteria. Approval for secured loans can be easier due to collateral. Unsecured loans may have stricter criteria. Borrower decision making. Understanding these differences is essential for borrowers to make informed lending choices. Interest rates comparison. Lower interest rates for secured loans. Secured loans generally have lower interest rates due to reduced risk for lenders. Role of collateral. The presence of collateral is crucial because it decreases the lender's risk. Borrowers' considerations. Borrowers need to evaluate the costs and benefits of secured versus unsecured loans. Risk factors in lending. Secured lending overview. Secured lending has lower risk due to collateral backing the loan. This security provides lenders with assurance. Unsecured lending risks. Unsecured lending involves higher risk as it relies only on borrower repayment ability. This increases potential defaults. Impact on interest rates. Higher risks in unsecured loans are reflected in elevated interest rates and less favorable terms for borrowers. Advantages of secured lending. Lower interest rates. Secured loans typically offer lower interest rates compared to unsecured loans, making them more affordable. Larger loan amounts. Borrowers can access larger amounts due to the collateral securing the loan. Extended repayment periods. Secured loans often come with longer repayment terms, providing borrowers more flexibility. Access for lower credit scores. Collateral backing allows borrowers with lower credit scores to qualify for loans. Disadvantages of secured lending. Risk of collateral loss. Defaulting on secured loans can result in losing significant assets pledged as collateral. Complex approval process. Secured loans often require extensive documentation and collateral valuation, complicating approval. Advantages of unsecured lending. Low collateral required. Borrowers can obtain loans without putting their assets at risk. This makes it ideal for those without collateral. Faster application process. The application process for unsecured loans is typically quicker than secured loans. This saves time for borrowers. Less documentation needed. Unsecured lending usually requires fewer documents, making it easier for borrowers to apply. This enhances accessibility. Disadvantages of unsecured lending. Higher interest rates. Unsecured loans typically incur higher interest costs for borrowers. This can lead to substantial financial strain. Stricter credit requirements. Lenders often enforce more stringent credit criteria for unsecured loans. This can limit access for some borrowers. Penalties for late payments. Borrowers may incur penalties for late payments, increasing the overall cost of borrowing further. Higher total cost of borrowing. Overall, unsecured loans can lead to a slightly higher total cost compared to secured loans. Real-world applications of secured lending. Real estate transactions. Secured loans are crucial for purchasing homes, providing necessary funds backed by property. Vehicle purchases. Secured lending facilitates car purchases, allowing borrowers to obtain vehicles with collateral. Business loans. Businesses often rely on secured loans to finance operations using assets as collateral. Real-world applications of unsecured lending. Common uses. Unsecured loans are often used for personal expenses, debt consolidation, and funding education. Borrower flexibility. These loans offer flexibility that can be beneficial for various financial needs. Cost consideration. Higher costs associated with unsecured loans should be carefully evaluated by borrowers. Conclusion: making informed choices. Advantages of secured lending. Secured lending typically offers lower interest rates, benefiting borrowers with collateral. This can lead to significant savings over time. Disadvantages of secured lending. The primary risk of secured loans is the potential loss of collateral if payments are missed. This can impact financial stability. Features of unsecured lending. Unsecured loans do not require collateral, making them accessible. However, they come with higher interest rates. Informed decision making. Understanding distinctions between loan types enables borrowers to choose the best option for their needs. This aligns with their financial situation. Thank you.